I was looking at my phone this morning, just scrolling through financial news while waiting for coffee.
Oh, yeah.
And it's just exhausting. It's this constant barrage of buy this, sell that, crypto's crashing, AI is the future.
Right.
It feels like you need a PhD just to keep your pulse steady.
It's the paradox of the modern age, isn't it? I mean, we have more information than ever before, but I'm not sure we have more wisdom
We definitely have more anxiety.
that we do.
Exactly. So when you brought these notes to the table, and I saw the publication date, 1949, I have to admit, I was a little skeptical.
I get that.
I mean, we're trying to navigate a digital economy with a guidebook written before the microchip. Is this really going to help?
It seems counterintuitive, I know.
Right.
But the book we're diving into is The Intelligent Investor by Benjamin Graham. And frankly, the fact that it's from 1949 is exactly why it matters.
How so? Because usually old in finance just means outdated.
Not here. This book has survived every trash, every bubble, every fad for over 70 years.
Mhm.
It's still a bestseller. And there's a reason Warren Buffett, who is Graham's student, by the way,
Not Columbia, right?
at Columbia, he calls this, quote, the best book on investing ever written.
That's a massive endorsement. I mean, coming from him, that's everything.
It is. So our mission for this deep dive is pretty clear.
Right.
We're not here to give stock tips or predict what the Fed will do.
Right.
We want to decode the system Graham built. We want to answer one question. How do you build wealth, surely, over a lifetime without becoming a nervous wreck?
Surely. That's the key word. Because I think a lot of us feel like investing is just gambling with slightly better odds.
And if you feel that way, Graham would say you're doing it wrong.
Okay.
His whole philosophy is about rationality, discipline, and keeping your emotions in check when everyone else is losing their mind.
So let's unpack that. If we're not gambling, what are we doing? Graham draws this hard line between an investor and a speculator.
He does. And this is where it all starts. He's incredibly strict with his definitions. He says an investment operation is one that meets three criteria.
Okay, what are they?
Upon thorough analysis, it promises, 1, safety of principal,
Got it.
and 2, an adequate return. Wait, I missed one. 1, thorough analysis. 2, safety of principal. 3, adequate return.
All three have to be there.
All three. If it doesn't meet those, Graham says it's not investing. It's speculation.
But hold on, people use those terms interchangeably all the time. I'm investing in crypto. I'm speculating on this stock.
They do.
And people make a lot of money speculating, right? I mean, look at the meme stock craze. Is he saying that's wrong?
He doesn't say it's immoral. He's not the morality police. But he warns that it's fatal to fool yourself. If you want to go to the casino, fine. But don't call it your retirement plan.
Right, it's the self-deception that gets you.
Precisely. Speculation is when you buy something entirely because you think the price will go up.
Right.
You're not looking at the business. You're betting on the crowd.
You're betting someone else will pay more for it tomorrow.
Exactly. Whereas the investor wants to own the business because the business itself makes money, not because the stock chart is going up.
So if my neighbor tells me a stock is going to the moon.
That's textbook speculation. And his advice is simple. Never mix your speculative money with your investment money. Treat it like a night in Vegas. Use money you can afford to lose, but don't bet the farm.
That's a huge reality check. We tell ourselves we're investing, but really we're just rolling the dice.
And this leads to one of his most famous ideas. He says, in the short term, the market is a voting machine.
A voting machine.
Yeah, it's a popularity contest. It's driven by emotion, hype, the crowd. It's how people feel about a company today.
Okay.
But in the long term, he says the market is a weighing machine.
Ah, I get it. So eventually the hype fades and the scale measures the actual weight, the real value of the business.
Correct. The intelligent investor ignores the voting and focuses entirely on the weighing.
That brings us perfectly to probably the most famous metaphor in all of finance, the story of Mr. Market.
It's brilliant. It personifies the thing that drives us all crazy.
So what's the story?
Graham asks you to imagine you own a business, say a hardware store, and you have a partner named Mr. Market.
Okay, picturing a guy in a frantic suit.
And every single day, he shows up at your door. Every day, he offers to either buy your share of the business or sell you his share.
Sounds handy. Liquidity on demand.
It would be, but there's a problem. Mr. Market is a manic depressive. He is completely emotionally unstable.
Okay.
So some days, he's euphoric. He sees nothing but sunshine. He thinks the hardware business is the future of humanity.
So he offers a high price.
a wildly high price.
Uh-huh.
I'll buy your share for $1 million.
And the next day.
The next day, he's depressed. The world is ending. The economy is collapsing. He knocks on your door and says, this business is worthless. I'll sell you my share for pennies on the dollar.
So the question is, how do you react to him?
Exactly. Would you let this guy's mood swings determine the value of your store? Would you panic and sell just because he's having a bad day?
No, I'd know what the store is worth. I know how many hammers we sold. I'd just close the door on him and wait for him to calm down.
That is the investor's advantage. But in the stock market, we do the opposite. When Mr. Market screams the world is ending, we panic. We let the servant become the master.
I love that phrase. A servant, not a guide. His wallet is useful, but his wisdom is non-existent.
Right. You have the option to just ignore him for months. He'll be back tomorrow with a new price.
Okay, so we ignore the manic partner and focus on real value, but how do we know what the business is worth? That seems like the hard part.
This is the margin of safety. Graham calls it the central concept of value investing.
Right.
But to get there, you first need a concept of intrinsic value, which is just an estimate of what a company is truly worth based on facts, assets, earnings, dividends. It's a math problem, not a feeling.
So let's say I do the math. I analyze a company and I calculate its intrinsic value is, say, $100 a share.
Okay, you have your number, $100. Now you look at Mr. Market. If the stock is trading at $98,
I mean, that's a discount. $2 off?
Graham would say absolutely not. Pass.
Really? Why? It's cheaper than its value.
Because you might be wrong. Your math could be slightly off. The economy might tank. A $2 buffer isn't enough protection from the unknown.
I see.
Graham wants you to wait until Mr. Market is so depressed, he offers you that $100 stock for $60.
And that $40 gap, that's the margin of safety.
That's it. That's the buffer that lets you sleep at night. It protects you against bad luck, mistakes, whatever the future throws at you.
He has that great bridge metaphor for this.
He does. If a bridge can hold 10,000 pounds, you don't drive a 9,900-pound truck across it.
You drive a 5,000-pound truck.
You leave a massive buffer. You don't test the limits.
That makes so much sense. But it requires so much patience. It means you have to walk away from good companies if they're just fairly priced.
You have to pass. You only swing when the pitch is perfect.
Now, I can hear someone listening and thinking, I have a job, I have kids, I don't have time to calculate intrinsic value. What's the plan for that person?
He absolutely has a plan. He calls them defensive investors.
Okay, defensive. I like that better than lazy.
Graham splits investors into two camps, defensive and enterprising. And he says you have to be honest with yourself about which one you are.
So the defensive investor is?
Most of us. They prioritize safety and freedom from effort. Their goal is to avoid serious mistakes and get a decent return with minimal work.
So what's the strategy? Just buy an index fund.
Sort of. He suggests a simple portfolio split, like 50% stocks, 50% bonds. And you rebalance.
And for stocks?
Big, boring giants,
Mm-hmm.
large established companies. He has strict criteria like they have to have paid dividends for at least 20 years.
20 years. That rules out a lot of modern tech darlings.
It does. But it proves the company is real. You can't fake a cash dividend for 2 decades. He also wants positive earnings for 10 years and a reasonable price-to-earnings ratio.
So no hot startups that just had their IPO.
Absolutely not. The defensive investor avoids hot trends. They are the tortoises in the race.
Okay, so that's the defensive side. What about the enterprising investor?
That's someone willing to devote the time and effort to get superior returns. They enjoy the research.
So they can take more risks.
Careful with the word risk. They can hunt for bargains, undervalued stocks, special situations. But Graham warns, being enterprising is not being reckless. You still need that margin of safety.
And what's the payoff for all that work? Am I going to get rich quick?
Nope. He says the expectation is only a few percentage points above the average. It's hard work for a slightly better edge, not a get-rich-quick scheme.
That's a tough pill for people used to seeing crypto bros on Twitter.
It is. But for everyone you see on Twitter, there are 1,000 who lost everything and aren't posting about it.
Fair point. Let's go back to the psychology. Graham says the investor's worst enemy is likely to be himself.
Yes, because we are wired to follow the herd. Evolutionarily, being alone was a death sentence. So we have this deep urge to do what everyone else is doing.
It's so hard not to. When everyone is making money, you feel like an idiot for sitting out. When everyone is panicking, you feel like an idiot for holding on.
That's the trap.
Yeah.
The common mistake is buying high in a mania and selling low in a panic. Graham says the intelligent investor sells to optimists and buys from pessimists.
That sounds incredibly lonely. and contrarian.
It is. It means doing the opposite of what feels natural. And to do that, you have to shut out the noise. Ignore the financial news. Ignore the hot tips.
He specifically warns about IPOs, doesn't he?
He does. He points out that companies go public when they can get the highest price, during periods of peak optimism. By definition, an IPO is rarely a bargain.
Okay, so let's get into the fundamentals. What should we actually look for in a business?
Comes back to the idea of ownership. Remember, a stock is not a ticker symbol. It's a piece of a real business.
Right.
And a real business generates earnings and, hopefully, pays dividends. Graham loves dividends.
Why? Is it just about the cash in hand?
It's about truth. Dividends are tangible proof of profit. A company that pays you part of its profits actually has profits. It's more trustworthy than one just promising future growth.
And this connects to the PE ratio, the price to earnings ratio.
Exactly. It's just a simple measure of cheapness. How much are you paying for $1 of the company's earnings?
So if a company earns $1 per share and the stock costs $15, the PE is 15.
Correct. And Graham has a rule for the defensive investor. Don't pay more than 15 times the average earnings of the past 3 years. If the PE is 50, you're paying for a lot of future hope that might not materialize.
The growth trap.
That's what he calls it. You're betting the company will keep growing at a massive rate. If it slows down even a little, the price collapses. He'd rather focus on what's real today.
It's all very grounding. It strips away the storytelling and just looks at the math.
It brings us back to the weighing machine.
So we know what to buy. How long do we hold it?
Years. Decades. Ideally forever.
The long-term view.
He is adamant about this. You have to give the weighing machine time to work. It might take years for the market to recognize the value you saw.
And what about trying to time the market? Selling right before a crash?
He dismisses it entirely. Says no one can do it consistently.
So if we can't time it, how do we get in, just dump all our money in at once?
Yep. He suggests dollar cost averaging.
Ah, the classics.
It's classic for a reason. You just invest a fixed amount of money regularly, say $500 every month, no matter what.
And the math on that is really cool.
It is. When prices are high, your $500 buys fewer shares. When prices are low, that same 500 buys more shares.
So you automatically buy more when things are cheap? It takes the emotion right out of it.
Puts the whole thing on autopilot.
Okay, let's summarize this toolkit. It feels like a checklist for staying sane.
It really is. 1, analyze before you buy. Know if you're investing or gambling.
2, understand Mr. Market. Use his moods. Don't let him use yours.
3, always insist on a margin of safety.
4, know yourself. Are you defensive or enterprising? Be honest.
5, stick to the fundamentals. Real earnings, real dividends.
And finally, think long-term. Let the value compound.
It's funny, the book is over 70 years old, but none of this feels outdated.
It feels more relevant than ever.
Because technology changes. But human nature doesn't. Greed and fear are timeless. Graham wrote a book about psychology as much as he wrote one about math.
So what does this all mean for you, the listener? As we wrap up, I keep coming back to the psychology of it.
It's the hardest part.
Because the math isn't hard. Buying $1 for 60 cents is simple. So why do so many people fail at this?
Because it requires you to stand alone. It needs this weird combination of humility and arrogance.
How so?
Humility to admit you can't predict the future, which is why you need that margin of safety. Okay. But also the arrogance, or maybe confidence, to look at the entire market panicking and say, you are all wrong and I am right.
That is a very lonely place to be.
It is. But that's the price of admission.
A fascinating deep dive. If you haven't read The Intelligent Investor, it really should be on your list. Thanks for exploring this with us.
Pleasure as always.
We'll catch you on the next deep dive. Stay rational out there.